Most people think that if they have a $500,000 annuity, it should produce a huge monthly paycheck. So when they hear the actual number, they're either relieved or deeply disappointed. But here's the issue: almost everyone is asking the wrong question. They ask, how much does a $500,000 annuity pay per month? What they should be asking is, why do two people with the same $500,000 end up with completely different incomes for life? And today I'm going to show you exactly how that happens, what actually controls your payout, and the mistake that quietly costs retirees hundreds of thousands of dollars over time. But first, let me give you a quick real-life example. A couple I met recently were both 63 years old. They'd saved just over $500,000 inside their retirement accounts. They were careful, conservative, and consistent. They'd done everything right. They went to a large brokerage firm and asked the same question most people ask: how much income can this give us each month? They were shown a number, it looked decent, but something didn't feel quite right. So they came to me for a second opinion. And when we ran the same $500,000 through a different strategy that reduced some market volatility, their monthly income was higher. But it came with its own trade-offs like fees, caps, and surrender terms. And it was guaranteed to last as long as either of them was alive. Same money. Two completely different outcomes. That's what we're breaking down today. So let's start with the question everyone's asking. How much does a $500,000 annuity actually pay per month? In general, depending on age, health, annuity type, and payout structure, that number can range anywhere from $2,500 to over $4,000 per month. Yes, that's a massive range. And no, it's not random. It exists because annuities are not a one-size-fits-all product. They're income tools, and the results depend on how you use them. So let me walk you through the key factors that actually determine how much income you'll receive. Let's start with the first one. Factor 1, your age when income starts. This one seems obvious, but people often underestimate it. The older you are when income begins, the more you get paid monthly. Why? Because the insurance company expects to make payments for fewer years. So someone starting income at 60 could receive far less per month than someone starting at 70 with the exact same $500,000. And once you turn income on, that decision is usually locked in. No do-overs, no adjustments. It's a one-way door. Factor 2, single life versus joint life. This choice can dramatically affect monthly income. Single life income pays more because it only lasts for one person. Joint life income pays less, but it guarantees payments as long as either spouse is alive. Here's the mistake I see far too often. Some couples chase the higher number, not realizing that if one person passes away early, the income might drop, or worse, disappear. A properly structured joint life annuity avoids that entirely. But again, the payout depends on how it's designed. Factor 3, the type of annuity you use. Not all annuities are built to generate income. Some are designed for growth, some for tax deferral, some just aren't efficient at all. And some, like fixed indexed annuities with income riders, are specifically built to maximize guaranteed monthly income. Use the wrong tool, and you could lose thousands per year without ever realizing it. This is exactly what I help clients avoid. Factor 4, guaranteed income versus projected income. This is a huge one. Some annuities show impressive potential income numbers, but those numbers are based on assumptions like future market performance, interest rates, or hypothetical credits. Other annuities guarantee income, no matter what happens. Guaranteed income is often lower on paper than optimistic projections, but it's real. It shows up every month, and it doesn't change when the market crashes. In retirement, real beats theoretical every single time. Comparing annuities without knowing what's guaranteed versus what's assumed, that's like comparing a salary to a commission and thinking they're the same thing. They're not. Let me give you a realistic example. Let's say someone rolls $500,000 into a properly structured annuity at age 65. They don't start income right away. They defer a little. They design it for guaranteed lifetime monthly income. That person might reasonably expect $3,000 to $3,500 per month for life. But the exact payout varies based on factors like age, premium amount, and rider options. If they wait longer, that number could go higher. If they structure it wrong, it could drop significantly. And here's the part most people don't realize. Depending on the contract and rider terms, the income can be designed to be less sensitive to market swings, though other risks like fees, inflation, and as insurer strength still matter. It doesn't require emotional decision-making. It just shows up month after month, year after year. That's why retirees with structured income plans sleep better at night. Now, I always get this question: why not just leave the $500,000 invested and withdraw from it? You can. Plenty of people do, but many regret it later. Because when you combine market volatility, withdrawals, and taxes, you open the door to something called sequence of returns risk. If the market drops early in retirement while you're pulling income, the damage can be permanent. An annuity doesn't replace growth. It replaces uncertainty. That's why even high net worth retirees still use them. Not because they lack options, but because they understand the math. So here's the bottom line. There is no universal payout for a $500,000 annuity. Anyone who gives you a fixed number without asking questions is either guessing or selling. Real income planning starts with your goals, your tax situation, your other income sources, and your retirement timeline. That's exactly what we do at Vertical Wealth Management. We don't start with products. We start with an income, wealth, and tax strategy. Then decide if and how an annuity fits. If you want to see how this works, there's a free video linked below that walks you through our process step by step. And if you want personal numbers, not just general examples, you can schedule a no-pressure call where we'll look over your situation. No obligation, just clarity. Because the real question isn't, how much does a $500,000 annuity pay? It's, is your retirement income engineered or accidental? And that question makes all the difference.